Pfizer is down 38% over the year and is still trading around its 52-week lows, offering a yield of just under 6%. But is it still undervalued and a strong buy? In today's episode, we're going to run it through our valuation model, getting to our updated intrinsic value and our acceptable buy price given our investor margin of safety, as well as seeing what Wall Street are forecasting for a price target over the next 12 months. We're also going to run through their recent acquisition of Seagen. We're going to take a look at insider trading that has happened over the last few months. We're going to take a look at their dividend safety, look at some of their updated financial metrics for 2024, and we'll see what institutions have done in the most recent quarter for Pfizer stock. We'll see how their performance has been over the last few months and how over the last few years, whether or not they are beating other companies in the industry. And we'll see how well their cash balance is, taking a look at their total debt to get a quick look of the health of the company. And as always, we'll take a look at how their revenues are progressing as well as their bottom line. So let's jump straight into the video. Now we can see they are currently having a forward PE of just under 19, and it is right there towards its 52-week lows. Now if you've been holding this for the last 10 years, you would be down around 1%. Now, it doesn't include those dividends reinvested, but that is a horrific return on any investment. And we can see it is pretty much right there at $60 for its all-time highs at the end of 2021. So let's take a look at some of these different things that we have mentioned. Firstly, insider trading. Now, what we typically look at is over the last few months. And what we can see is that Scott, the director of Pfizer Incorporated, did in fact buy 3,000 shares not too long ago, in fact in the 15th of December, around $26 at $79,000 worth. Now it's important to note that insider buying, in our opinion, is considered to be bullish. The reason why insiders buy is because they believe the share price will go up in the short to medium term. If insiders sell, it's not necessarily bearish. They do sell for a wide range of reasons, personal reasons, financial reasons, but this is a bullish signal in our opinion. Now let's take a look at what the institutions themselves are doing. It is 68% institutional ownership. Now there has been a fair amount of selling over the last 12 months, around 11 billion, but a lot of buying by these institutions, as we can see, 96 billion worth. Q2 was the largest buy of 74 billion. Q3, though, we do know, in fact, more selling than buying, and Q4 again more selling. So in the most recent quarter, Q4 of 2023, institutions sold nearly twice as much as they did buy. Lots of different things to digest there, but as always, we should do our own due diligence and not rely on what the institutions do. So now, very briefly, we can take a look, and they have completed their acquisition. We can see this from a few weeks ago, the middle of December, of Seagen. Now, this is a company that they were looking to buy for quite some time. This was valued at around 43 billion, which they bought with cash, as we can see here. And we are going to take a look at their balance sheet to discuss this very shortly. But it does look to be, as we can see, further establishing Pfizer as a leading oncology company, poised to accelerate the next generation of breakthrough treatments, specifically with cancer. So this seems to be a very bullish signal for Pfizer. They are acquiring companies which they do believe to be the right companies, and we'll touch upon that when we look at their balance sheet in a few minutes. So let's take a look at the industry as a whole. Now, it should come as no surprise over the last year, including those dividends reinvested, Pfizer is down 35%, the worst performing in the industry. But it's important to note that only two companies over the last year in fact turned a positive return. We have ZTS and GSK. Now when we expand that to the last 5 years, Pfizer is also down 15%, as well as being the worst performing in the essential market. But do remember, past performance is never an indicator for the future, and it's interesting to note that the other companies all returned positive returns on your investment. So something just to consider there as well. So let's take a look at the balance sheet for Pfizer. Remember, quick health check of the company. Now their cash went from around 19 billion in 2018 to their latest quarter report of 44 billion. So in fact, more than doubled their cash position. Now, something just to bear in mind, they do hold a lot of cash. We did see that Seagen, they did acquire that company, but it isn't just the only company. They have been doing other acquisitions rather than organic growth due to the amount of cash that they did get from that COVID year. We can see that huge bump from 2020 to 2021. Now, when we compare this cash position to their total debt numerically and directionally, we can see it has gone from 42 billion to 64 billion. So yes, their cash has increased rather dramatically, but we can see their total debt up nearly 50%, and we'll consider that in one of the metrics. So let's take a quick look at the income statement. Now, what we look for here, for those that are new, 3 to 7% growth year on year. No surprise for those that know Pfizer and what they're about. Their increase to their revenue was significant, 41 billion to 100 billion, with a lot of this coming from COVID period, which helped them a lot. So that's why we see for the trailing 12 months in 2023, their top line is expected to reduce from the COVID bump that they had. But we do notice before COVID, from 2018 to 2020, their top line was fairly flat. So the question will now remain as to whether or not they can increase their top line from 2023 onwards with these acquisitions that they are doing. In terms of the bottom line net income, well, we can see that it's also increased 11 billion to 31 billion, although again, do note, similar to the top line, the net income is expected to reduce from the previous year. So just a few questions to ask yourself and a few things just to consider. Now, before we jump into the dividend safety and financial metrics, but before we do, just to let you know, we are starting a free weekly newsletter where we will be running through the 7 golden dividend metrics. We'll be taking a look at some deep dives of companies that we'll be sending out every week and talking about margin of safety of different companies as well as our watch list. If you do want to get these free weekly emails, do click on that pinned comment below and subscribe. So let's jump straight into the dividend safety, a score of 75. It is safe. Market cap 159 billion, a mega cap company. So when we take a look at those recessionary metrics, for those that see a recession inbound, they cut the dividend in the last recession. Above average growth, negative 6% versus the S&P 500's negative 12%. And they did also outperform the S&P with a negative 45% return versus negative 55%. Dividend growth, there was a recent increase over the last few weeks, 2.4%, very poor considering it's not above that minimum 4% we advocate on the channel to keep in line with inflation, although the last 5 years and last 20 years have been fairly solid at above inflation, and they have been increasing those dividends for the last 12 years. Dividend yield theory then states a company is undervalued when the current yield sits above the 5-year average, 5.97 versus 3.9. First sign of undervaluation, but as always, we never look at these models in isolation and we'll draw our conclusions toward the end of the episode. Forward PE, 18.6, so it actually sits higher than the 5-year average of 12.1. And we can see it is pretty much in line with the healthcare sector PE of 18.3. So let's take a look. Remember, we do ignore the earnings data. It is susceptible to manipulation by management through accounting. We focus on the free cash flow. Below 60%, my personal preference, gives me faith that management essentially can offer double-digit increases. Now, this is why we look at the free cash flow. 2023 is expected to be 57% on the earnings. But when we can see here, the free cash flow is saying it's expected to be 112%. What this means, that management are expecting to pay out more in dividends in 2023 than they're generating in free cash flow. It is a red flag, something just to be aware of, especially given how nice and low it was in the last 2 years of 2021 and 2022. Free cash flow payout, well, one thing to note here, yes, it has increased over the last 10 years, but if you strip out these 2 COVID years, for Pfizer from 2013 to 2020, it was pretty much flat. So unless they find another essential catalyst to increase that top line through these acquisitions, then it will come back down like we're seeing expected in 2023. So something just to consider for investors and potential investors. Again, when we strip out the COVID years from 2013 to 2020, their top line was in fact flat, if not reducing. After that, it did start to increase, as you know why. But again, 2023, they're expecting a massive hit to that top line. And numerically, you can see that going from 52 billion to 69 billion in 2023. On a more positive note, they do share buybacks, returning excess cash to investors, 6.9 billion to 5.72. So that is something positive to note. ROIC, it is one of my 7 golden dividend metrics. We look for 10% or more. The reason for this, it gives me faith that management are essentially effectively able to allocate their capital. 2023 dropping to 11%, which I'm not surprised given how consistent that was before the COVID bump. Now when we take a look at the margin, something we expect from companies in the industry, consistent and very high numbers. Now on the operating margin, it has been fairly inconsistent, although still strong numbers. 2023's 26% is positive. 12%, even though it's the lowest of the last 10 years, it's still positive, but it's just a bit of a worry given how high it was for such a long time. Finally, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us the balance sheet strength as well as dividend safety. 2022, 0.41 years to pay off all of their debt net of cash on hand. 2023, 1.08. It is increasing, but still below the 3, so they do have a decent balance sheet, and we can see that dividend does look to be safe. So let's jump into the valuation model. As always, if you enjoy the content, values being provided, smash the like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. First model, Graham's valuation. We have the stock ticker symbol, the earnings per share, long-term growth rate. We have that current yield on AAA corporate bonds, giving intrinsic value of $29.70 with our first sign of undervaluation in comparison to the market value. But again, we're not looking at any of these models in isolation and we'll draw our conclusions towards the end. We then have the multiples valuation. We have these companies in a similar sector and size, their average P multiplied by that of Pfizer to get an intrinsic value of $38. Again, another undervaluation signal. Now looking at the dividend discount model, we can see those yearly dividends. Now an average growth rate of 3.83. We have gone more conservative looking out at 3.25, and therefore we get an intrinsic value still showing signs of undervaluation. The fourth and final model, we have the DCF, the free cash flows year on year, the average growth rate per analyst estimates. With that discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, divide by the equity. We have the equity, in fact, divide by shares outstanding to get the intrinsic value at $41. Again, fourth and final undervaluation signal. As always, if you do want to grab a copy of the model that we are running through, do click on that pinned comment below where you can get to the intrinsic value and acceptable buy price of companies in your own portfolio and those on your watch list. So as always, we start off with a 10% margin of safety if we believe the company meets 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. We can see it is a buy up to $32 if you believe that to be the case. 15% still a buy up to $31. 20% not too far off the current trading price, and at 25% we can see you need to wait to $26.93. So right now we see around 20% margin of safety for Pfizer. In terms of Wall Street and what they forecast, well, they have a price target of $33 over the next 12 months, so they see around 16% upside to this company. As always though, do let me know your thoughts in the comments below whether or not you have been buying Pfizer. It currently yields a 6% yield dividend, but at the same time there are risks with this company. It has been hammered quite a lot. There are some talks of litigation, but my personal view is that there are a lot better, higher quality companies. We did run through a video yesterday talking about pharma companies which did take a massive hit in the healthcare sector. Personally, I did add companies like United Health, like Diligence that we discussed yesterday. Right now, I don't see any true value with Pfizer over the longer term, but that is only personally because I like to buy higher quality companies, which in my opinion, UNH and ELV are, as well as some of the others discussed yesterday. As always though, do let me know your thoughts in the comments. A lot of people I know have been buying Pfizer and will continue to do so, especially with that attractive 5% yield, or 6% in fact, and we do see around a 20% margin of safety. As always, have a great day, catch you on the next episode and take care.